And everyone, welcome to another edition of Your Money Radio. Danny Stewart, Alex Catutes, Don Vandenbord. It was an act of God to actually get this this podcast going today. It's like they don't want us to do it, Alex, but we got to, because the people need us. The people want us. The people love us. They love me. And so, you see that, Danny?
Me.
Especially now, though. Especially now.
Especially now, they love Don. And the thing, you're noticing Don's not on camera. Don got a new haircut, and his internet connection his internet connection is repelling his head. So we got to figure out in the future where Don went. There's Don.
Well, that was uncalled for. I just want to say how sweet my new haircut is. And then if I have problems, I'll drop back off and just do audio.
Okay, so Don can handle his own technical stuff. I don't know what the hell happened to my computer, but Gremlins got in there. But we are ready to rock and roll. So I want to get right into it. Let me give you the lay of the land of the show. Let's do violent sell-offs without a heads up. I'll show you the new VX futures. So everyone knows I like this VIX futures inversion. I want to talk about that a little bit today. And there's a new VIX inversion for 2021. There's always, look, this is why I like trading and investing. There's always something new. I'm going to, I want to go over some charts, okay? And there's a lot going right with this market, and there's a lot going right with a certain set of charts, and I want to show you those charts, okay? Alex is going to do SPACs or Wack. That's what I'm calling it out.
Say it again, SPACs or what?
SPACs or Wack.
Your Wack. SPACs or Wack.
Yeah, that's the lingo the kids are using, right? And so I say, Alex, are the kids still using Wack? And he's like, dude, you're so old. And I'm like, yeah, I know, I'm 35, but I look.
That just made the headline. That's the lead.
SPACs or Wack. Yep. I want to do narrative too. We'll talk narrative. Don's got a whole bunch of updates. And I want to talk, if I have time, talk about consumer stuff. But let me show you something here, stock nerds and market lovers. So I'm looking here for VX. So let's look at VX here real quick. So when I'm looking at, let's see here, the VIX futures. So I only look at the first 3 months. I look at the current month, I look at the next month, and then I look at the forward month. And so when I'm looking at the VIX futures, I'm looking for an inversion. I'm not going to explain the inversion and what I'm looking for. I've done that enough. What I want to point out to you is one, Don, what's the widowmaker in trading? What's the thing that leads to more divorces than any other product?
UVXY.
That's right. You ain't got no alibi if you're trading that. And so look, VIX are down. Like, market's real volatile. The VIX futures are down today. They were up earlier, but now they're down. And so it's a really quick trade. The VIX doesn't act the way you think it should act. You're like, what the hell changed in the 2 hours from when they were up till they never got inverted? And so like, what's changed? I don't get it. And the thing is, it's not a product I think you should be endeavoring it. There's better ways if you want to hedge or you want to take advantage of volatility. There are much better ways to do it than trading VIX products. But here's the thing, and I got this from talking with Alex, and that wasn't the basis of our call when I was talking with Alex yesterday. It just evolved into the discussion where normally, Danny, do you remember, I think Don had just joined us, or maybe it was shortly thereafter. It was 2015. It was August of 2015, and China, and it was the Greece thing, and then there was a China issue with the devaluation of their currency. I don't even remember that. So Alex did exactly when I mentioned it to him, and so we're talking, and I said, it used to be that when I got a VIX inversion, I had like 3 to 4 weeks to operate. Where, hey, Danny and I got the VIX inversion. It was the first time I had brought it out to the general public. I'd used it privately. It was the first time I'd used it with clients, and we're talking about it out loud. And so July, it was the last week of July, got the VIX inversion, and Danny and I just started paring back long positions. And until by the end of the third week, or the start of the third week in August, all we had left was gold, bonds, and a short. That was it. And then the market cash. And we went limit down. We went limit down Sunday night, and the world was in hell in a handbasket. I remember this. because I was actively, doing all this Sunday night, sitting at the old house with Tanya, and I'm like, the next time the time frame got a little. The next time the VIX inverted, the time frame, instead of 4 weeks, you had like 2 weeks, and then the next time it happened, you had like a week, and now, and then the last time the VIX inverted, it was like the next day. That was last year. Now, with this market, with interest rates where they're at, with things evolving economically the way they are, there's no buffer. But you're not getting any inversion. You're not getting the inversion. Like, you got the inversion maybe at the end of last year. I remember the last time we got the inversion, and then the market just resolved itself. Now you're getting sell-offs without the things that you're like, that I'm looking for. Like, hey, is this a normal market? And I'm telling you the difference between, and we had this discussion, Don, like a week or two ago. I can't remember if it was 2 weeks ago or just last week. What's a normal market? A normal market for me is when the VIX is not inverted. When the VIX is inverted, meaning the contract's price, every contract, the shorter contract price is above the next month's contract, and that contract price is out over the third month's contract. You're not even getting that now. And so it appears to me that what we have now is what we've been talking about on the show and in the videos for a while, is the TNX warning. And so let's put the 10-year Treasury in. And this isn't news. It's just not a timing tool, because the market's been fine while the TNX, if I show you the TNX here, this is a daily chart of the TNX. And here's the TNX.
Explain what that is. Explain what that is.
The 10-year, thank you, Danny, the 10-year Treasury index. And so how you read this is the yield on the 10-year notes is 1.487, okay? And so, but 210, like down here in 210 land, we weren't talking about this horrible, awful, no good freaking market. And so, but you've been steadily going up. And it wasn't until you got above this third ATR up here on this day, over here, and then yesterday was the big day, that, it really started to just fall apart. The TNX has never been a timing mechanism for me. And when you went to bed, I want to put all this together, because you can't look at things. I don't think so. If you're at home thinking you can, God bless you. You can't look at things in the singular. You can't look at things going, that one piece of information is going to make me want to sell, unless it is Jay Powell is going to stop printing money. Well, that one thing would make me want to sell. But other than that, there's very few things that you can look in a vacuum and go, that's the piece of information. No, you need a preponderance of evidence. And so when you go to bed Wednesday night and you're looking at the micro caps, right? Get this on a chart you're used to seeing. Micro caps closed at an all-time high on Wednesday night. Now my charts are not going to operate. So I'll just continue talking and maybe my charts will catch up. Micro caps go at an all-time high. There we go. The Dow goes out at an all-time high. The Russell is a beautiful chart. Here's the micro caps on Wednesday. Here is the YMs on a Wednesday. Here is the RTY on a Wednesday. And these are not bullish charts. I had the video Wednesday. I went over them. So to think that if you're saying, oh, I knew this was coming, well, a sell-off's always going to be coming. A pullback's always going to be coming. But the things that worked in 2020, I mean, the whole trigger was the indexes were breaking down in February, and then you got this big VIX inversion, and then the market rolled over. Like you had your checklist of things. This is a new dynamic to the markets, and now I think people are going to be, if you want my opinion, I'm going to swing it around here in a second. If you want my opinion, and my opinion is just as valid as anybody else who's listening here, it's an opinion. Stocks are going to do what, Alex? Sideways, up or down, right? Sideways, up or down. And so I think what you're seeing here is people will over-index to the bond short a little too much. Let me show you where we're at on the NDX, which is the index that I think most people are concerned with. So let me get this on an ATR chart. Let me move it out a little bit here for you. And so now you've come down to negative 2 ATR, and you're finding support. And it's just like when you get up here to this 2 ATR level here, that you're just trading in ranges, I believe. And I could be wrong. I mean, I've been wrong before. Trading in ranges. And I think what you're going to see is what took place last October. So let's pull this on a weekly chart. Let's get this on a weekly chart set. And so here is the middle of October. So this is sort of the 3rd week of October, 4th week, 5th week of October. And look at what you do. You test the 21, okay? And here you've come down, and this is a weekly 21. You've tested the weekly mean. This makes sense to me. Like this is, could it be the start of something huge? Yeah, it could be, but for me, and I know Don might have a different metric. I don't want to put words in his mouth. Maybe Alex has something different. But for me, I think if you take a step back, what you're seeing is violence. That's why we're going to talk about SPACs today. Violence in certain groups of stocks. But you're seeing, it's not ambivalence by any means, but you're seeing a bunch of other stocks really holding up well. And so, Don, I think everyone on this podcast is a fan of William O'Neill, without a doubt. I mean, Don talks about him all the time. And so on his videos, look, there's a set of charts that I like to revert to, especially when I want to know the bigger picture of what's really going on. And I revert to the weekly charts. And I want to show you a couple of things here. And then, Danny, I want to get your thoughts on Bob. I want to get everyone's thoughts on, because look, the best part about this show is its authenticity. Don or Danny or Alex could disagree, and that's what makes them, one, a market, and two, it's the best way to get to the right answer, because living in an echo chamber is the worst thing I think you could be a part of. And so let me go over some charts here real quick with you and show you what I'm talking about. Here's Square. I still have Square personally. I'll go over all the trades I did I have the Friday night video. When Square comes down to the weekly 21, which it hasn't done since last May, that appears to me where you want to take your entry. Now, does it mean it's going to go right back up? No. But when you're seeing these stocks with these big monster runs, and there's a whole bunch of them, like let's look at Chipotle, right? Chipotle is down here at 1100, and it trades right now. It's trading at 1400, and that zone is the last time it was at the weekly 21. And you can see where to come down to. It tested the weekly mean. And I'm not cherry picking stocks. I can bring up any stock, and we'll bring up the ones that aren't working. And those are the ones you stay away from. Alta Beauty. But I say Alta Beauty gave you an opportunity. Well, right here is below the weekly 21 in November. How about some housing stocks? MHO. Weekly, look, basing, makes its move, weekly 21 test. Now it's in the zone of the weekly 21. Let me think. Google. Last time down at the weekly 21, if you had a chart, so William O'Neill says, I don't know if it's in his book or if it was a quote that's been passed around, but I really took it to heart. The charts he'd go to an island with, if he had no other chart sets, were weekly charts. And if you notice, if you ever were a fan of the paper or you go on the site, the charts that they're presented to you are weekly charts. You could choose daily, but the charts in the paper were always weekly. And when you're in these kind of moments, I'm like, okay, what are the weekly charts telling me? Now, if your risk parameters have been exceeded, sell, wrap up risk. But when the VIX isn't inverted, I see stocks like Google, Chipotle, Alta. I got to look at my notes. Let's look at Tesla, which is everyone talks about Tesla. The last time you were down at the weekly mean, we'll call this the weekly mean, was April. The last time you got to test the weekly mean was April. So look, I'm not saying that Tesla, you run into Tesla. I'm not saying any of that, but I'm saying that you should be using weekly. What I am saying is I use weekly charts to get perspective. Now, if you entered at 900, okay. Now, yeah, look, listen to me now. If you entered at 900, we should talk, because I want people to understand you're not making a decision in a vacuum, okay? But if you entered at 900, let's go back to our ATR charts and talk about using all this information together. I haven't changed it. It's still a weekly chart here, okay? But think about this, and you've spent a lot of time at the upper ATR band. The propensity for a pullback to the mean exists greatly. That's the risk you're dealing with. We talk about the ATR charts all the time in regards to the daily charts. It works just as well as on a weekly chart. It works just as well on a 78-minute chart, on a 195-minute chart, on a 30-minute chart. It's what time frame are you trading? But if you're trading off the daily charts, do have a look at the weekly charts. Understand where you are in time and space. That sounds like hindsight. It sounds preachy in my head. It's not meant to be, because there's a bunch of stocks that aren't working here, and I don't think merit your entertaining them to study. Like Facebook. Facebook is doing what? Trading below the weekly mean, and it's up 4% today. How about Amazon? It all depends on where you entered, but Amazon trading below the weekly mean. Oh gosh, how about Walmart, WMT? Look at that, trading below the weekly mean. The stocks that go on these great monster runs, they often will, in these markets, like, I don't know. I mean, maybe we're about to roll over and it is all hell in a handbasket, but as long as the indices right here, so I'll put up SPX, still on the weekly charts, test the weekly 8, NDX, below the weekly 8, above the 21. That would be DJI, the Dow, at the weekly 8, RUT, rut, above the weekly 5. It's hard to get bearish right here. That doesn't mean there aren't pockets of just awfulness. And I'm going to butcher Don saying, I'm going to throw it to Don here, I think, where Don on a daily chart gets worried below the 200. Is that right, Don?
I get petrified below the 200. I get scared below the 50.
Yeah. So let's do this now, Don. I'm throwing the.
Okay.
Yeah, I'm going to throw it to you. Go ahead.
Yeah, William O'Neill used weekly charts, but his big thing was the 10-week, which is equivalent to the 50-day moving average. And really the big sell rule was a weekly close below the 50-day moving average or the 10-week moving average. If you give your stocks all the way down to the 21 week is the equivalent of the 100-day moving average. If you hold on that long, you better be saddled in for big drawdowns. I'm not a fan of the 21 week. I want to cut below the 10 week.
Mm-hmm.
I don't give them that much room.
Sure. I'm not saying you hold on to there. What I'm saying is get some perspective. Like, these stocks are just correcting to their weekly mean. That's normal and healthy.
Yeah, they are, but the ones that are going all the way down there, I don't consider them leaders anymore. You should have held your 50-day this week if you're a true leader. If you're one of the if you're one of the last ones standing, I think you should have held your 50-day this week.
Fair enough. Alex, what you got? Oh, you got anything else? I'm sorry.
And there are some that broke the 50-day. There are some that have broken their 50-day, rallied back up, and are failing at their 50-day. And if you can't get back above the 50-day, and we're saying we're trafficking in the leading stocks, I'm crossing those off of my leaders list. They won't be in my top 21, 25, whatever you want to call it. And obviously they won't be on the 21 over 21, which just is the cream of the crop. This is the ones that survive. If you survive the week over the 21-day exponential moving average, you're a true leader, surviving the carnage that we saw over the last 2 weeks.
Alex, what you got?
Well, alluding to Don's point, correct me if I'm wrong. I think O'Neill, when he would look at indexes, he would only use a daily chart. On stocks, he would use weeklies. Is that right? You tell me.
I don't know. I get a lot of perspective from the weekly charts. Okay. My entry in Square I still have it personally. Came off the weekly 21.
Yeah. I'm just saying for indexes, if we were to look at the Compex, it's easier to decipher what's going on the daily than rather the weekly, because some people would never know the carnage that ensued this week with some of these tech names. And alluding to Don's point with the 21 EMA and 50-day, compare net to, let's say, Micron.
Let's do
You got
it.
one stock
Let's do it. So
sitting
NET,
under the 50, and you got another stock trading above the 21. So this is off my leader list right now. I'm not even looking at it anymore. It
Right.
looks bad. And then look at Micron, completely opposite.
Yep.
So I don't know. I mean, I like using the weekly too, but when you're in it and you're just trying to get into investing, it's hard. Like that takes years of experience and patience to use that. And I think long term, you have a really good point. That 21 EMA is famous trader was Weinstein. The Weinstein base is off the 21-week moving average. So I guess it just have to know yourself. Where's your time parameter and where's your risk profile?
That's exactly right. And
Yeah.
so, and it all matters where you got in. And so this is what will happen. And who knows if it actually comes to fruition. So here's the TNX. The market is trading off the TNX. And you can see it's the market. So this is, look at this on a 5-minute chart, 15-minute chart. So here is the start of the session. So you'll notice here's where TNX started, and then it peaks right here. So this is what time? 10:30. So European close. So let's look at 10:30 on the NASDAQ. So we'll put the QQQ up, and we'll look at the 10:30 time frame on the NASDAQ. Here's 10:30 right here, and you get what? You get a little bit of movement. The market right now is queuing off the 10-year treasuries. But that's so much for individual. That's so much for people that if you're in front of your computer all day and this is what you're doing, this is your living, you're in it. Okay, great. I just don't know how much the average investor is paying attention to this.
That's a really good point.
Like right now.
Yeah, they're not, because
Yeah.
they're looking, and all that gets quoted is the Dow and the S&P, and those have barely budged.
Right. And the lower that the TNX goes, and its probabilities. And so like the point I want to make here is I just don't think the overall point I'm trying to make is I don't think you take action where you need to take action where you need to feel comfortable. Don't not take action. I just think that there's going to be a group of people that are about to get their souls ripped out that have gotten over bearish. But that's markets. That's what happens in markets, and it doesn't have to be that way. When I was talking with Alex yesterday, I thought if that we had a third. And by the way, there's still 3 hours left in this trading session. So if we close the way Thursday went, I would think that there's the potential for a huge sell-off on Monday. But right now, what are the Qs up, Don? Right now, 1%.
The Qs are up 1.5%.
Yeah, if we close out like this, maybe Monday's just, I don't know, maybe Monday's just a normal day. But here is a daily chart, and you can see we've ridden this rail up here. The pullback is going to occur here. This is extended, and so it doesn't have to pull all the way back to the mean. It could just trade sideways here, like it didn't get to the mean here. It could just come up, give a little pullback. Markets were good here. Like if you look at the 125 market in January, they weren't that bad, but this is the action. When you look at the start of January, TNX shoots up, excuse me, and then it pulls back. So what is the date here? 112, pardon me. So QQQ. And we look at here's 111. Where's 111? 111, get a little bit of grouping here. And then you end up eventually going higher. Now the market's back with the TNX up, and that's clearly the algorithmic trigger to what's taking shape here. For me to say the TNX isn't going higher here, it absolutely, positively could just rip, but it's pausing at a really key point here at this third ATR, and I wonder if it pulls back, and then you get that reversion to the mean.
Excuse me.
No, you're all right. You get a reversion up here. So here are the Qs. Here's the mean. You come up, kiss the mean, and that's probably where the rubber meets the road. Doesn't have to play out that way. You could be forming a bearish flag here, and it never breaks this upper trend line right here, and we roll over. I mean, we can create any kind of scenario that could happen, but I do believe in the probabilistic nature of the markets, and I think those weekly charts are a clue. But like I said, I could absolutely, positively be wrong. Danny, what do you think about bonds?
Well, hang on. I'd like to clean up a whole lot of that. There's a whole bunch of points there, overarching stuff, and
Okay.
it all kind of makes sense if you kind of tie it together. This was a very sharp, quick pullback, and this is the hard part of the market. It's not the fun part. It's the hard part. And now, it's very swift.
To clarify though, it was only a sharp, harsh pullback in leading growth stocks.
Yeah, right. All right, the leading stocks. It was a very sharp, harsh pullback. And now, is it a correction or even worse yet? That's still to be undetermined. We kind of came down to some key levels. A few stocks broke, like Don said, but some held and went back up. Leading stocks don't necessarily, I mean, they cycle through. So just because they were a leading stock last cycle doesn't make them a leading stock this cycle. That's why if you're going to do leading stocks, you've really got to pay attention and watch them, because you're going to have to change them out. You can't just stick them in your closet and let them sit there. Now, as far as, Tim was talking about the VIX futures inverting, and they didn't really get an inversion. That's true, but the spread between the 1 month, 2 month, and 3 month did get very close together. They flattened. So they're very flat. So that's showing you that risk is rising some. Inversion means, I almost said Tim's word, oh crap. Anyway, so that means that risk is rising, but the rising interest rates is real key. Now here's the takeaway. It does depend on your time frame. Don is a little bit shorter term in nature. He wants to keep it very tight, and he wants to not give him that much room, and that's fine. Tim is right. If you've got a good entry and you're trying to hold for a little bit longer time frame, then you can use weekly charts. But if you buy them at the top, Bob's your uncle, you'll be down 15, 20, 25% before you hit the weekly. So buying, it's not just selling discipline, you also need a buying discipline. But aside from all that, let's really talk about where the risk is in this market, because we're talking about stocks. Let's talk about bonds. Does anybody realize that Treasury bonds lost 9% this month? Does anybody realize they're down 13% for the year? Treasury bonds, not high yield bonds, not junk bonds, not speculative bonds. These are supposed to be the safe bonds. Okay, now, Jim, if you pull that interest rate, that TNX up, the 10-year Treasury interest rate. So Tim told you how to read it. It's that 14.68. That's 1.46. If you go back and look, it went from 1.07 to 1.4. Folks, that's 0.4%. It didn't even go up 0.5%. And long-term Treasury bonds sold off 13%. So what happens if Treasury bonds go up 2%? Are we going to lose 20, 25, 30% in bonds? Bonds in this particular cycle with interest rates this low, thank you, Fed, are as easily as dangerous as tech stocks. If you don't believe that, you don't understand the deal. Now,
and by the way,
tech stocks have a lot more upside. So if I've got the same downside risk, but I got a whole lot more upside, that's an easy choice, folks. These 60-40 funds are going to get dragged down, not because of the 60 stock side, because of the 40 bond side. So you need to figure out what you're going to do, and you got to look at both. It's not just one indicator in isolation. You got the future, the VIX 1 month, 2 month, 3 month futures. You got the rising interest rates, and then you got the exponential moving averages. There's lots of things you can look at. And when they kind of dovetail together, and they give you what's the word? Not corresponding, a collaboration. When they confirmation. when they confirm each other, you can be more confident that that the move you're seeing is real. So right now, is this market going to roll back over and give up the ghost, or is it going to move higher? It's a little too early to tell, but you've got to be ready to go either way. You've got to have a plan for either way.
And gold isn't a place to hide either. And so, you know, the adage gold fights inflation. Well, the TNX is going up because the market, you know, the old mantra is the market, you know, stocks go down when interest rates go up, and the market is sensing that there's going to be inflation. But you've had Jay Powell come out and tell you that they're zero interest in, I couldn't find a better word than interest, Annie, zero interest in raising rates. And so I'm really keen off of. Now, could it be out of the Fed's control? We could argue that. There's so many things we could argue. And
Yes.
I don't argue, Danny, that's why but I don't argue stocks with people. I don't argue any of this with people. I present what I'm interpreting. Other people have differing opinions. Great. But that doesn't mean just because let's say that I think interest rates are about to, you know, stay stable or even pull back slightly here. What if they don't? You know what I'm going to do? If the market gets worse, I'm going to sell my holdings. It's price before conviction. And so if price is dictating something, you have to take action. Like you can't just sit there and continuously get kicked in the gyms. But what I don't even fear it. Like, people are going to do what they want to do, and people here, like I've been doing. Danny, we've been doing this podcast so long together. We always find the one or two people that just hear what they want to hear, no matter what we say. Like I even can preface it, and I've tested this where I'll say, "Look, you're going to hear what you want to hear," and then I say something, and some, you know, right after that sentence, and they come back with quoting me in the exact opposite form. Look, if interest rates don't act with the probabilities, fine, take action. But there is a lot of overreaction right now in markets. Like there's a lot, like if you know, I've got my ear to the ground, Daniel. You know, I've got an open DM box on my Twitter feed. I've got an email inbox. A lot of overreaction. Look, we used to, I don't want to joke around. I don't want to joke around, but we used to get a lot of people that in essence, when they'd come into the office and meet with Danny, they'd say, I want all the gains and none of the, and that world doesn't exist. If you step into the ring, you know, and into a knife fight, you're going to get cut. And these analogies or these little ditties, they don't make it any better. But being able to think clearly and keeping with your plan is absolutely everything right now. And so Don, you saw what Don thinks of my perspective on weekly charts, right? It's not, I mean, you just heard what he said. Alex has his thoughts, Daniel has his thoughts. And so what your plan is, you have to be able to enact. And I feel, as I transition to Alex here, that a lot of people are wrapped up in SPACs. Well, we know they are, okay? And a lot of these have gotten just devastatingly cut in half, more than cut in half. And so what happens in times like this, now you're a long-term holder, and this is, you know, well, no, it's not even funny, because so here's what SPACs.
Stuck is the word. You're stuck.
Yeah. Like here, well, you could sell. I mean, here's the thought about what SPACs have done. And I disagree with Charlie Munger about like Charlie Munger made headlines this week. You know, if you shovel enough poop, you know, people will buy it, you know, or something like that, in that realm. And it's asinine. Like, you know, like, because it's like the people with the money are only allowed to invest in newer technology and newer startups. And so if you're not familiar with the way SPACs work, so a management team pools money, and they're going to go look for an acquisition target. So you're buying the management team. But here's the thing, if you're not an accredited investor, you have enough money to blow it, is what the government's saying. You can't go be a venture capitalist. You can't be an angel. You know, you can be an angel to like a startup down the street working out of the garage, and no one's going to prevent you from doing that. But if you will invest in a fund that's really smart at evaluating startups, the new technologies that are going to come out that are going to change the world, you can't do it. And SPACs break through that. SPACs are the democratization of startups. It's just like the internet. The internet democratized information, and just look at how glorious the world is. SPACs are doing that. Now, are all SPACs great? No. Is every room in the internet great? Hell no. So use a little common sense here, people. But the fact that you're getting the ability to invest in a management team that then goes and finds the startup, and the management teams tell you what they're looking for. There's financial, there's fintech, there's retail space, consumer packaged goods space, there's automotive. They're telling you. So if you're interested in the space exploration, there's a SPAC for that. That's how SPCE came public. Well, Richard Branson's company. And so you have the ability now to do this. Here's the key takeaway, not the key takeaway yet, Alex. I swear to you, I'm getting to you, brother.
Oh no, I'm listening.
But people need to understand this. When you have a private company, it doesn't trade on the open market. You're not staring at price every day. And think about Robinhood. Robinhood at the end of January, right? It's hey, we're going to IPO. It's going to be great. All the people are using Robinhood. Imagine if Robinhood was public and it was $100 stock, and then they have this GameStop thing happen, and they have Vlad, their CEO, come out and just kind of bungle things for a little bit. That stock goes from 100 to 1.
It was down today.
Oh, Robinhood was?
Yeah.
Okay. There you go. Irony. And so like they're clearly having growth pains, but their total addressable market has never been bigger. The fact that so many people are up in arms about what's happened. Let me tell you something. TD, Schwab, Fidelity would love to have their growth. But the stock itself, if what happened at the end of January, and they came out and they said they had liquidity, that's why they weren't saying they had liquidity issues, even though clearly they had liquidity issues. At the end of January, it would have went from 100 to $1, like $99, $100 to 1. And you don't see that when it's a private company. So when you invest in private companies, you just know that they're working every day at whatever their mission is, whether it's Branson's company with space exploration, whether it's Blue Origin from Amazon, which is not, or Amazon's Jeff Bezos, which is Musk's company, or you've got Vlad over at Robinhood. But now that you've got SPACs, now that you have SPACs, you know the price, and it changes the game. And so you have to ask yourself, when you invest in a SPAC, are you really investing in that new, that belief that technology is going to just take this to the moon, for lack of a better phraseology? Then you're going to see what Alex is about to present to you. Amazon gave you, hey Don, you look new. Amazon gave you like 397% losses in its journey. Nobody remembers that, man.
No, I didn't even know that.
You have to be prepared for that. And I'm not saying that you hold through it. I'm not telling you what to do, but I'm telling you that SPACs offer you an opportunity. Look at what happened with Airbnb. You didn't get to get in on pennies on the dollar like all the VCs did when it came public. You got the public price, and it stayed private a hell of a lot longer. These companies now, imagine getting Home Depot or Microsoft when they were in their growth formation, like they were actually taking
millionaires.
Yeah, like when they were actually taking your money to grow. Mm-hmm. Airbnb doesn't need your money. They can go out and raise the money. Robinhood doesn't need your money. They went out and raised $3 billion over a weekend for liquidity. They don't need your money. The companies that are coming public right now, though, and through the SPAC process, they're going to take your money and try to grow it. Now, whether Frisker makes it, I don't know. And I wouldn't castigate judgment one way or the other. What I'm telling you, though, is this is a new paradigm. And it's awesome. But you're going to have weeks like this. And I want Alex to show you exactly. Alex, you tell me, here's how it works. You tell me the ticker, tell me the company, and let's rock and roll.
Well, I want to start with how if one thing works, doesn't mean the other 99 things are going to work. So let's pull up Livongo first, because that was a SPAC last year that merged and ended up being a true market leader. Yeah, so you can pull it on the little bit longer term. There we go. That was a SPAC at like $15, and look what it did. So this can kind of, I guess you could say, poison people's minds. And you're not going to necessarily have that happen, let's say, with, look at some of these names like CCIV. Are you guys getting a delay?
No, I'm not.
I'm not seeing Tim.
I think Tim might have froze.
Yeah, he froze.
Can you hear us, Tim?
Yeah, his picture's gone. Alex, keep talking about CCIV.
Yeah, so
Yeah, I can hear
CCIV
you.
is highly speculative. I mean, I even had friends hitting me up about it. I obviously I didn't buy it, but it shot up to I think 60, and this past week it split wide open and came down to 27 off the top of my head. Yeah, look at that. So people may have made money, but these are really dangerous tools to invest in, as you could say, because can you really do your research? And there's no earnings call. Like, how are you going to decipher these companies? And I mean, when I pull up MarketSmith or IBD, I can't pull up the fundamentals on what's going on. I really don't know. It's a crapshoot, and we're not in the casino business here at Revere, and I would never touch that type of name. The only name that I have touched personally was Butterfly, was BFLY. That was recently a SPAC. But they already hit the ground running.
BFLY.
Yes, they make a medical device, an ultrasound device. They're already in the hospitals. They already make money. You really have to do your research if you're going to invest in these. And listen, I lost money on BFLY. I had to sell it. That just goes to show you, someone that's looking at the charts every day, as myself, I lose money too. I make mistakes, and I got taken to the cleaners on this name. It just merged. It was the quote before that was LGVW was the SPAC, and then they just merged this last week.
Okay.
I don't even think LGVW.
Well, it won't. It'll be Butterfly now, I think.
Yeah. Does it show up differently now?
It doesn't.
Is that what it does? Okay. Well, you
It's
can't
only
even see
Butterfly.
what it was charting before, but it went from 15-ish, 14 if you started looking at it, to 29 last week. It was extended, and then now it just fell right through the floor back to the teens. So this isn't really something that I would focus on. There's other names. Look at STPK, another SPAC. I mean, how do you measure this? How do you decipher this? You're going to have to research the company and then find out what on their blank check company website. It just, you can't look up the board members. There's no history behind these people. It's something that takes time to develop. Now, go ahead.
Well, what I was going to say is, so I agree with Tim to some extent, but I'm concerned that retail investors, he says it's a democratization and it allows non-accredited investors inside these, into these deals, but there's also room to take advantage of retail investors. So when you do an accredited investor means you got $1 million net worth, not counting your home and your cars and stuff. And Tim's right. The regulators feel like if you get conned and lose your money, you had enough money, you could have hired a accountant or a financial guy or someone to investigate it, and they're not trying to protect you. You can go out there and lose your money. But if you got $1 million or less, that's who they're really trying to protect. So that's why these private placement deals or private equity deals are for accredited investors, and they make you a pitch and they give you this. Here's what we're visioning. Here's what we're trying to do. We're investing in this Silicon Valley startup tech stock or this biotech or real, whatever it is. And you can kind of investigate the management because it's early stages. So you don't have a long track history. Some of them may have already been there for a couple of years and they've got some numbers but most of them are losing money. They're not profitable yet. Now these SPACs allow the individual investor, the retail investor, the non-accredited investor to jump in there and invest. But whenever you do even accredited private placement deals, you never want to take more than 3 or 4% of your money in any one deal, and you want to spread it out amongst 5 deals or so that your total private equity may be 10, 12, 15%, unless you're extremely wealthy and you can afford to lose 25, 30% of your money. But if you pick out 5 deals or 6 deals, most of them are going to lose money and they'll lose all of it. You won't get any of it back. But there'll be a couple or one that really goes through the roof, and that'll make you a nice return. So with these SPACs that retail investors can get into, the one thing you can't do is you can't put all your money or a big chunk of your money in one deal. You got to spread them out on a couple different deals. But if you are going to underwrite them, you have to underwrite the management team. Who's putting because look, I'd much rather have a mediocre idea with great execution than have the greatest idea since sliced bread, but the guys aren't good, they don't know how to run or manage the company. And you have that a lot of times with tech or engineering firms or whatever, where you got the head tech genius or the head engineering guy running the company, and he's the vision of the idea, the technology, but he doesn't know how to run a company very well. And really, it'd be better to have a professional CEO that knows how to run a company and let the guy do the research or be out there as the point man answering questions and doing that stuff. So with these SPACs, basically, you're right. In fact, a lot of them, Tim will even tell you, a lot of them say, we're raising a bunch of money and then we're going to go out and find the deal. Well, so you don't even know what necessarily it is sometimes. You just know the general area they're focusing in. So that's
Danny,
why you're really betting on the management.
Can you hear me?
Yeah,
Yes.
I can hear it.
Oh, great. Yeah, no, you're right there.
I like the fact that they're taking power away from the big ivory towers of Wall Street. I love the fact it's almost like the GameStop fiasco where all these big short sellers were working with some of the custodians and trying to hurt the retail investor, and they still, hurt these guys and did their own thing. Because before, it's always been an exclusive buddy. We always call it the traditional advisor brotherhood. It's the big Wall Street players that call all the shots and make the rules. And now all of a sudden you're circumventing these private deals where they're charging big exorbitant fees and raising money, and you're taking it straight to the retail investor, and it makes it very cost effective to be able to get into some of these deals. But remember, these SPACs are high risk. They're speculative. And so that's why you got to have that in a section of your portfolio. And look at that gap Tim just had. So also those SPACs, they're harder to chart because they are so volatile. They're harder to put on a technical chart pattern versus something like Amazon, Apple, or even Tesla, because they do have these big volatile moves. But in any event, the whole point is it's great, but they take a lot more under it.
It's great when they're it's great. It's just like any stock. They're great when they're going up. And it's this when, somebody bought 64.86 and now it's trading 30. And there could be nothing wrong. Someone who doesn't, that's why I don't argue stocks with people. I don't even like discussing them for the most part, because nothing changed with CCIV. They're like, nothing's changed with their deal. It's literally what the market's valuing at. And that's tied right now to what interest rates are doing. And that's hard for investors that's hard for most people to comprehend. That's why I think you're at a disadvantage if you can't read the intercorrelated assets, or at the very least have a trading plan. But
Dan, would you compare this to the penny stocks of 1999?
You asked Dan, but I wouldn't.
Yeah, I asked Dan, I mean, because I'm guessing Dan was trading those back in '99.
I didn't really trade too many penny stocks, but I was aware.
I actually did. That's how I got my start, Alex. Like,
Oh, okay.
I was not yet a pilot. I was waiting to start pilot school in 99, 2000. And I was stashed at a thing called VT2 up in Pensacola, Florida. And I worked for a gentleman named, well, I won't mention his name. It doesn't matter. But I was working for the senior Marine at the squadron. And like we had one of those old 486 computers in his office. He'd go fly and I'm like, do you have any work for me to do, sir? No. So I love stocks and I didn't have any money. And so the first time I was getting a regular paycheck in the Marine Corps. And so I taught myself how to trade penny stocks. I would go on the bulletin boards. Then it was Raging Bull. I'd figure out what everybody was talking about. I'd be like, oh, okay. And then I'd figure out how to make like 500, 600 bucks a shot, when stock would go up like 1/100th of a cent. And I devised like my own system. And so the major comes in one week and he says, what are you doing in here, Lieutenant? And I said, trading stocks. He goes, that's illegal. I was really, majors I was such a boot, Lieutenant. Like, hey, you can't be doing that. That's illegal on government computers. And I was like, oh my gosh, I'm so sorry. I thought my career was over, right?
Get out of here.
Before it even started. And then he looks at me and goes, when I come back from flying again, you're going to teach me what you're doing. And I thought, oh. And so then it turned out like all the pilots in the squadron who were interested, because everybody was interested in the market then. It was 99. And they were like, what's your system? And then they started calling. And I'm like, I was so scared. I had to set up every night a voicemail with my picks with the disclaimer that I don't know what these things are going to do tomorrow, but this is what I have. And they would call and I wouldn't answer the phone. I'd let it go to the voicemail and the outgoing message was my stock picks. And then it all fell to shit. And
that's what I was trying to get to is, I mean, I would say probably 9 out of 10 of those companies probably went bankrupt after the tech bubble bursted. And maybe there's a SPAC bubble going on that we are seeing the retail that really don't do the research trying to trade to make a quick buck.
I think that anytime that you try to make a quick buck, it works out sometimes, and then other times it bites you so incredibly in the ass that you don't want it. You realize you need something more than just trying to make a quick buck. And so that's why I'm a proponent of, I wait for the mean, whether it's a daily mean or a weekly mean. I try and wait for those in my trading plan. And look, this could be the best entry in Frisco. I don't know when they actually changed the ticker symbol from Churchill to Frisco Automotive, but this could be the best entry ever in the stock. We don't know. I mean, right now though, I'll tell you that trends shift. Like take Okta, where or I talked about in my video this week where I made a mistake. Take Okta. So Okta here, when it's 2 closes below the 21, and I said, I'm playing with fire, holding this thing. And yeah, I got burned. I held it 1 day too long. And 2 closes below the 21 on the daily chart typically initiates a trend. Now, whether that trend's a short-term trend or it's a longer downhill slide, I don't know. But those 2 closes below the 21, and you got the same thing in Tesla. They typically start trends lower. And it's the same thing on the back upside, TSLA. Up here, at 810, those were your 2 closes. Okay, it's probably time to get out of this thing. The stock is not doing its job. And you're like, well, Tim, tell me about the weekly entry. Sure, let's tie that all together so I don't get hypocrite email. So we look at a weekly chart. Okay, so if you got out, like this is trade. I know that's a little scrunched up. So here is that 780, 810 zone. It's that week right here. Okay, well, you can step out of the way and you fell all the way back to the weekly mean. I don't know if that holds, but the gulfs between the daily 21s and their 50 days is just huge on a lot of these stocks. And it's the same thing on the weekly charts. And so look, right now the NQ is up. Like, let's look at the NQs real quick. like the markets, if it keeps going like this, you'll see a bunch of short covering into the close. And it's just the over, and this is a bearish chart. Like but you're up 1.7%. And so it's everybody who has bad location on their shorts, and they're gonna, if you're a bear, you don't want to see this. And then if you tie it together, like let's look at the put call ratio here. So here's the put call ratio. You have a moving 10-day moving average that's been trekking higher, which is secret put buying. This is the high, look at this high level right here. Like this is the highest level you've got since that opportunity you had to buy the market after the election.
Tim, what's the difference between that one and the dollar sign CPC?
Hold on a second. You tell me where you see CPC, and I will tell you what it means. I'm sorry.
So like you can put it in your quote screen. Put dollar sign and then CPC.
Oh, I don't know what CPC is. I use PCA.
It's supposed to be the put call ratio.
No, how I learned it, and you're the first person who's ever mentioned that to me. I use put call. The new level is about 0.7, where I have this red line drawn on my chart, and it all changed in 2020 with the printing of money and everything that took place. So
the one I look at is against the CBOE total.
This is everything.
Okay, gotcha.
Yeah. And so here, look at this. This is what date? If I can get the date to pull up for me, 10:30, and look at what happens here. And then you get another opportunity right after the election, and it just drifts higher. This up here to 0.7 puts in a short-term bottom. We very well could have put in a short-term bottom. Hell if I know, but I know the signs are there. And on a Friday even, an improving advanced decline line, a put call ratio that's trimming higher, little wiki bottom here, and the put call ratio. There's more people right now buying puts. Could they be right and we just crash? Maybe, but I've seen this enough times to know that people get over indexed either to the bullish side or to the bearish side, and the ATR charts help me keep all of that in check.
Well, look at APPS as a leading stock, and look what it's doing today.
Yep.
I mean, that's strong action as a bounce.
Right off the mean. And it's just interesting to see what's happening. By the way, 12:30 typically starts the most bullish, 10:30 Central, most bullish time of the day. But just look at what the 10-year Treasury's been doing. Bleeding. It's a 5-minute chart since 10:30. So look, if the 10-year Treasury ramps up into the close, well, then you'll probably see stocks pull back. But it's clearly what the market's triggering off of right now. Don, a lot of moves this week. Let's I'm sorry, Alex, was that all you had for SPACs?
Yeah, no. Let's let the captain of the ship take the reins.
I want to know what Don's shirt is first.
It is Eagles Jimmy Buffett concert from a few years back.
That would have been a good concert.
That was fun. I'm going to boil down to the survivors and of these last 2 weeks, and it breaks into 4 themes. I'm going to call these the 4 Horsemen themes to survive the apocalypse. Online gambling, highlighted by Penn and DraftKings. That's PENN and DKNG. Social media with accelerating growth in Snap and Twitter. Friendly internet content. People talk about Facebook and Twitter. I don't like some of what they do, but you can't argue with the price action and the gap up that's being held. Friendly internet content. People like to complain about Facebook, how it divides people. Nobody complains about Pinterest and Etsy. They're feel-good internet content sites. Pinterest and Etsy, and commodities, FCX and Mosaic. Mosaic is an ag product, but getting in with the inflation, food inflation theme. So those 4 themes and those 8 stocks did a great job of surviving the carnage over the last 2 weeks.
All right. I want to talk about any of the moves, or is that all you have, Mr. Don?
Look to Tuesday and Thursday's video to see a ton of things that we got stopped out on, and we really need to get the NASDAQ 100 back above the 50-day moving average to close the week. For now, the NASDAQ shorts that we have on will stay in place unless we get back above the 50-day moving average.
Okay, Danny, I've got one last thing. After you do the normal close, take us through how people can reach us.
I will. One last thing, folks, the plan, you need to have a plan in place in advance for when, not if, but when rates rise in earnest. Because when rates rise in earnest, there's only going to be one or two places to hide, and it ain't going to be bonds, and it's not going to be quite a few stocks. So you need to have that plan in place in advance. You may need to make that plan like you're sipping a pina colada on the beach, not when you're in the trenches and bullets are flying over your head. You don't want to be making decisions under fire. Have a plan in place, and then you can just follow the plan when things happen. Folks, listen, if you like what you heard, please tell a friend, tell a neighbor. You can send them to revereasset.com. They can go to the subscribe button. They can enter their email on this podcast weekly on Saturday morning. We'll go into their inbox, as well as our daily market insight newsletter video, short 10-minute video. We won't spam them. We won't reach out to them in any way. It's up to them to reach out to us if they want our help. Also, you can go to webinars. That's a separate one, and that is for Don's Lunch and Learns. He just did one, but he does them about every 2 to 3 months, time permitting, on Wednesdays at noon Eastern time. And if you sign up, he'll send you an alert when that is coming. And they're an hour long during market hours. Are great, and you can do a Q&A. And even if you can't attend because you're working, then he'll email you the copied link. You can email any of us with questions. Made it real easy for you. Dan at revereasset.com, Tim at Revere Asset, Hunter at Revere Asset, who was taking a very difficult test today. Good luck, Hunter. Alex at Revere Asset, and Don at Revere Asset. You can always call us old school at 855-REAL-WEALTH.
I've got the video tonight, so we'll go over a bunch of things on the 5 at 5. But look, the easiest way to get a hold of me is Twitter. You can email me. My inbox fills up at TJ Razor. You can get Danny, one Danny Stewart. And I tell you this because sometimes the quickest way to get a hold of us, it's brevity. You can just message us right away, and we'll find you. Oh, D Vandenbord is Don, at one Danny Stewart, and then at TJ Razor. But I tend to get back to people at the end of the day, not during the day, in early morning before market opens. Danny and I were talking this morning, and amongst things, it's not applicable to trading, but Alex triggered a thought yesterday on a phone call where Alex was talking about, narratives, and somehow we led to the discussion about money on the sidelines. And that money on the sidelines is interesting because it ties into a piece. I was trying to pull it up on my computer. I can't. I'm having my data have all the tech issues today, so I can't pull up the piece. But Danny had some thoughts about what I had brought up in our morning call, where I said the U.S. consumer has never been in a better position. And I study retail like a hawk. I'm very keen on the buying and selling of goods or retail. And right now, like last year, I don't know if you're aware of it at home, but last year, and this isn't to take away from anyone who has been hurt by COVID, who has lost their job through COVID, like we're like you, a bunch of people in our worlds have suffered. And so look, a ton of empathy here. But as the facts merit out, the recession that took place last year, not only was it swift, it was the first time in history that personal savings grew and wealth grew. And that's never happened before. And it doesn't mean the economy, and Danny's like, as soon as I said that, I think Danny just let out an exasperated sigh when I said that. And and what Danny's thought was, I believe, was that the economy you know, the economy and savings rates, you know, they're two different things. The economy can be in bad shape in certain areas, and they absolutely are, like the leisure sector, you know, like even though airline stocks have been going up, I don't think airlines are out of the blue, are they, Danny? They're in the clear.
You can't replace, here's the bottom line, you can't replace real growth with funny. I mean, that's what they've done. They printed a bunch of money, they stuck it in the system, they propped up things. So now we may see a reacceleration when the economy opens back up, but make no mistake, the economy is not strong right now. That's not accurate. Now,
And yet and this all came about because a number was released Friday morning that if I can find, gosh, I don't know if I can find it.
and by the way, there's lots of studies that show when people's savings rates go up, Tim, when they're scared. When they're scared and they're nervous, squirrel it away. They're not out there spending confidently.
Right. And so what happened was the personal savings rate went up. Here it is. Household income jumped 10% in January, and spending grew 2.4%, priming the economy for a burst in growth this year. Maybe that comes true. Maybe it doesn't. But I do think that there is, you know, based on what factual studies that you can read on, you can find them online, or I can send you the piece if you'd like it. Tim@revereasset.com. There's a bunch of money on the sidelines, and so
I agree with that. Yeah.
Yeah, and when Danny, sometimes I think Danny's favorite word is bifurcated, and the time that it's absolutely warranted here is in this economy. It's definitely a bifurcated economy, and it's why you saw that uprising with GameStop. You know, where people, seemingly everyday people like you and me, were making money in GameStop, and then the powers that be, quote unquote, shut it off. You know, and it's the same thing about SPACs. You know, people now have access to this, and so it'll be really interesting to see how we progress here with these interest rates and what's going on. But
and I do agree with you. There is pent up demand. So if people get confidence that the vaccine is working and people get confidence that the economy is opening, you could see a big surge in spending. I would agree with that.
And whether it leads to the roaring 20s, like after the 1918 pandemic, that led to, and we all know how the 20s ended in the last century, right? And so, you know, I always say that this thing's going to end horribly one day. Like it's all going to be just awful. But that could be tomorrow, or that could be 10 years from now. And so, if you're in the overly bullish club, you know, maybe temper some enthusiasm. But if you're in the overly bearish club, I think that's just as dangerous too. So take us home, Daniel.
Folks, if you like what you heard, please tell a friend, tell a neighbor. We'll talk to you next week on Your Money.